All right, welcome back, guys, to the CRE Spotlight. We're really excited to have our friend and guest speaker today, Dylan Clark. And we're going to have Dylan introduce himself and talk about some topics to help educate our audience.
Hey, thanks for having me on, Andrew. My name's Dylan. I am an RIA and private wealth manager based out of Illinois. We specialize in anything finance, so whether it be taxes, merger acquisition, debt financing, reconstructing of an entire portfolio, asset protection, asset management, we kind of handle it all. I know, Andrew, you wanted to kind of talk about today some other topics in the real estate market. Most people are focused on interest rates currently, which is a good thing to be focused on. They do play an important factor, especially when we look at the type of debt leveraging we can get, our debt service coverage ratios, our DCRs. How much capital can we deploy and still make a profit based on the income that we're getting in and service our properties. I think the thing that people do is they get so tied up in that they don't tend to see other factors. Um, you know, Interest rates, while they do play a big important role, they're not by any means the only factor in it. We have to look at valuations of things that go on. We have to look at the potential for economic downturn. I know a lot of people tend to say, everyone needs a place to live. And while that is true, if you're someone's who has units, say, in a blue state opposed to a red state, your blue state eviction is going to be hard if they stop paying their rent. Even in red states, it's going to take a little bit, potentially, depending on how your contracts are driven up. So, let's just say hypothetically that I mean, we are in a recession, but this thing gets, picked up more and people are really starting to hurt to the point of they can't even pay their rent anymore. So what happens to your model when you're running it and say 95% occupancy and it's that now and it's great. So you're able to cover your debt service, you're able to cover all your expenses, have some extra. But what happens in the event that you're an unfortunate individual and you drop to 60 because people stop paying rent? How does that kind of play out for you? Do you default, or do you have to take cash flow from other assets and kind of spread yourself a little thin to cover those payments? Um, Other things like that. So I think the conversation of strictly interest rates and being bilinear with everything is not necessarily wrong, but it's leading people down a wrong path of analyzing risk and understanding, I guess, what it is that they're getting into.
That's a really several good points there, Dylan. Um, one of the things we often look at is everybody in our industry just wants to focus on what's the maximum amount of loan to value or loan to cost we can get because we got to lever up our returns. How little can we, hold in reserves because we don't want idle dollars? And you're bringing up a great point. Losing the asset potentially, being in non-compliance with your bank, that's a pretty serious issue. And
Yeah.
one of the other factors that LPs often grumble about in the background is all we really talk about is raising rents, which raising rents are great, but that's in a hell of an assumption because you might not always be able to raise rents. Even on the capex side, all the capex that I usually see in a pitch deck or webinar, they're usually revenue oriented. Like, and I'm not saying they're bad things, but like improving the signage of the building, very important to get more people to see your place and obviously improve your rent. But things like capital improvements for water and electric, things that lower operating expense, tend to get short shrift in a bull market, right? When things are easy, you don't worry about expenses.
Right.
Yeah, we'll just put 3% and draw a linear line and we're good. Um, Obviously we're seeing wages go up and we're still having inflation issues. Well, we're having disinflation. We're not seeing deflation of costs. So what do you think for operators in real estate to, instead of focusing so much on interest rates, to really take more of a holistic approach and remember that NOI also includes reducing expenses?
Yeah, I think reducing expenses is a bit of a challenge. everything's kind of fixed. So, your water bill, it's going to be pretty well fixed. Your electric bill, it's going to be pretty well fixed. I know they have the solar kids who walk around doing door-to-door sales, trying to get people to switch their supplier of electricity, the solar, and that, sometimes that brings it down, sometimes it doesn't, but that's the only thing I know of, at least, to kind of bring that cost down. I know there's rubs where you're putting it onto the person directly, but that's not really, you're just transferring the cost. You're doing what a CPA does and moving it from box A to kind of box B. So it's still really the same. As far as bringing down those types of costs themselves, I personally don't know of too many ways to kind of get those down, unless you are, working with the electric company and saying, hey, we're using this X amount a month, can we try and find some sort of specialized rate in there? But then again, if you're only running a 32 unit complex,
Oh, yeah.
how much electricity are you using compared to a huge business in this, in the same city? So I don't think there's too many ways to reduce those types of costs from that standpoint. Now, the the rehab side of things, if you have window seals, say, that are not able to keep in air and heat, if your insulation isn't very good, all these types of other things that you can control, just by spending the money to fix those over time, I think they can add up tremendously, opposed to necessarily that immediate return. I like to think that anyone can do real estate. It's not exactly the most challenging thing to do in comparison to other things in the financial industry. I come from the equity side. I've always been in the stock market. That, from what I have seen and what I've heard from other people, 20 times harder than real estate as far as getting good at it. So experience of understanding risk as well in this is something I think people lack a lot. They don't understand how financial markets work, how money works, how debt works. So it kind of leaves them exposed to conditions that we're going into now. We, what, a year ago, not even a year ago, you could go in and get 80-90% leverage on your property. All of a sudden, you're at 60% leverage. So you're having to go and raise out 2-3 times the capital that you were raising a year ago. Not only that, but your payment on your mortgage or your loan that you're taking out is at least double, if not more than double. So it does, all of these things kind of do play an effect into it. And, well, of course, you want to make as much money as possible. There's a time and place to make as much money as possible, but there's also a time and place that you need to play defensive, suck it up, accept the fact that, hey, this is going to suck for a little bit, but if I can weather the storm on this, it's going to come out a lot better, and I'm going to come out a lot more ahead than I thought I would, even though I kind of had to sacrifice now for it. It's a sacrifice now and get paid later kind of scenario is where I see things at currently, if you are going into a new position now, or have recently gone into a new position within the last 3 to 5 months.
Yeah, I mean, for many of us, we're looking at as LPs, we're always looking at getting our depreciation and our bonus depreciation, and redeploying money because we don't like having money on the sidelines. But right, recency bias is making it very hard because everybody remembers the guy that posted on LinkedIn, bought it 18 months ago, sold it for 100% gain. Those days, I think you're going to agree with me, are probably few and far between, recurring. But unfortunately, for a lot of LPs, it's still in their mind of that's the barometer for success. And I think
Right.
you'd be saying, no, 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 no. Really be looking at your downside risk and a risk adjusted return.
Yep. I know I'm gonna make a lot of operators mad and capital raisers mad, but
Oh, don't worry. Go ahead.
if I'm an LP, stay away. I wouldn't deploy the capital right now. The bonus depreciation and cost seg returns that you would get are, in my opinion, are very negligible to the amount of risk exposure that you'd be taking on currently. If you would want to wait, say, 6 months from now as home prices really start falling off. Because here's the situation that we're in the housing market. It's my bull case for it at least is a total freeze. So we have buyers coming in trying to buy way under market value, but we also have sellers wanting to kind of hold off and not hit that lower bid because they're still in la la land from 12, 18 months ago trying to sell for top dollar. So it's going to create a total freeze in the asset prices. So if you actually go look at listings and whatnot, there's hundreds of thousands of listings out there for properties. It's now a buyer's market. The sellers, unfortunately, are still in la la land and they're going to have to hit that lower bid eventually. So if I'm an LP and someone's, coming in and saying, hey, I had this amazing off market deal, it's listed, purchase price of 10 million, it's quoted to be worth 10 million, you know, great. I hope this deal works out for you. I'm going to wait 6 to 9 months and, catch $1 million discount or two, or maybe even three, depends on how this goes. I'd see at least 10% discount minimum in the next coming months. I think we're gonna see, 5 to 10 within, 6, and then potentially even greater through 9 through 12, even into 18 months out. So, if I'm an LP, I'm waiting. I'm holding capital, I'm reserving it, I'm waiting for the lower bids to get hit by sellers, and then I'm going to start looking to deploy my capital back out. Now, we need to look at it from a risk adjusted rate of return too. So when we look at it from that perspective, cost sagging, your bonus depreciation, I mean, that's negligible to me in the conversation. Yeah, it's going to save you on taxes, but there's other things you can save taxes on that are going to give you the same benefit. It becomes a numbers game, unfortunately. So is holding onto your capital now worth the projected potential of a decline in the market? To me, the answer is yes. I'm always going to be holding on to this thing. It's never worth deploying capital right now into something that hasn't fallen back. So, I've done the study on it already, but real estate versus the stock market it's interesting how that works. Just because the stock market falls doesn't always mean the real estate market's going to fall. And people have made that argument. What I don't think people who have made that argument don't realize, though, is the expansion of asset value during those time periods. So if, let's just say, the 2000 .com bubble, equity prices went crazy. It was a tech bust. It wasn't housing that went parabolic. Yeah, sure, housing did come up, as a part of all the extra cash and growth that we had due to a result of that, but it wasn't to the extent that, say, it was in 08. Even though, so people weren't expanding into real estate in 2000 like they were in 2008. So it's not a one-to-one comparison. If the stock market goes down, real estate goes down. However, why is the stock market going down? That's the key question. We have over injection of capital in the markets. We have, huge PE ratios. And now we have everything's kind of pulling back as interest rates tighten. There's no more debt leveraging to the extent that we were getting it. Companies who were able to get debt issued to expand their companies at, say, 1% are now at 4.5, 4 to 4.5. The bond issues, if they were issuing bonds, they were issuing them at 3 to 4. Now they're having to go issue new bonds at 8 to 10. So they don't have as much capital, so everything's naturally going to slow down. People are hurting for capital, so they're going to sell their stocks, they're going to sell their equities, yada, yada, yada. The game goes on. But that interest rate decision now plays into this. As inflation rages on, as interest rates rage on, you need more capital to live. And that's just the unfortunate truth of it. So to kind of tie it all together, looking at the reasoning and the underlying problems that are in the financial system, I think, are what's best going to tell you whether or not real estate, I guess, is going to fall back in where your risk lies if you're looking to deploy, at least currently now.
Yeah. I mean, there's going to be people, myself included, that are going to push back and say that from a high level, that's all lovely and good and academic, but that real estate, unlike some of the other capital markets, is highly inefficient. So there's always these outlier pockets. You know, for you, there's, you know, a house 3 blocks down the street, you know, the some knucklehead painted the interior walls black and it smells like, you know, cat pee. And you know, instead of being priced for $200,000, you know, it's priced for 125. So there's a 75% cat pee and ugly paint discount. And you know very well, you know how you've, let's just say you have the background in cat pee remediation and you know how to paint. And you're
Right.
like, okay, it's going to cost me $15,000 to remediate cat pee and paint. So there's, you know, that 60 gap spread. And to you, you're like, okay, that's the arbitrage I'm willing to take, put in my, you know, a couple weekends and, you know, buy some paint and whatever it takes to remediate cat pee. There's going to be people like me that say, Dylan's right. It's incredibly harder now. My bar should be much higher. You know, we should be really looking for real outliers, exceptions. But some people would say they're still worth looking for, and it's possible to find them if you have the right team, like the kind of people that that's all they do full time, not, you know, the weekend warrior real estate investor. You know what I mean?
Right. Yeah, if someone has come to the real estate game 2020 or after, those are the people I'm running from. I wouldn't even touch it. Even parts of 2019, 2018, even then, I mean, that's still kind of risky, but it's not as bad. Because, you know, were there real estate courses and things back in 2018, 2019? Sure. But from a social media perspective of what went on during the COVID crash, everyone needed money. Everyone wanted money. Everyone wanted to do this. Everyone wanted to do that. So we had this big boom of, you know, I saw it especially in the stock markets, like a bunch of retail traders. I think everyone at this point has heard of GameStop and AMC and what happened with that situation. So it's just been this big boom of retail people. So, you know, in the stock market side of things in 2020 and even through 2021, I could throw money at anything and I was probably going to make a 20-30% return within a week or two. It wasn't very difficult. Now, not so much. So, you know, and all these kids and whatnot, you know, came through a bunch of cookie cutter courses. They all kind of went through the same thing. And even the people teaching them had only been in the game for, you know, a year or two, or maybe it just started. You know, I know tons of people who launched a course only a year into trading, you know,
Oh my
claiming,
God.
you know, to be experts and this and that and yada yada yada. So you get a bunch of people who have read the same course from someone who doesn't really have that much experience in things, and then they go out and do it and it works because the conditions are absolutely perfect and prime for everything they say to work one to one, are now going into conditions where that does not happen anymore. Things don't work out as great as they did. So what the problem now becomes as an LP investor is, okay, I need to look at the risk of my operator as well. So how long has my operator actually been doing this? Have they been doing their own deals for many years? You know, or did they just start in 2020 or 2021 and did they just catch the most perfect and ideal time to become this individual? And are they going to actually be able to weather the storm? How knowledgeable are they of being able to pivot in tough situations and kind of put the rubber to the road and accomplish what they want to accomplish?
I know you're a big fan of quotes and, you know, the Warren Buffett quotes in particular. There's several we could use, but, you know, I know you love the idea of, you know, bull market makes everybody look like a genius. And I paraphrase, or, you know, we don't really know who's swimming naked until the tide comes out. I know that's
Yep.
one of a mutual favorite of both of ours. So yeah, it definitely is a concern for me, as an LP investor. And I get a lot of people that call me up and just, you know, want to pick my brain for investment ideas. And, you know, I always just fall back on, the last few years, everything's been nice and good, and you could paint the outside and turn on and flip a house, or you could paint the outside and flip an apartment building. Don't assume that those days are still here. Obviously, I know you're going to agree with me on that.
Yep. And not only could you do that, but people are going to come in and pay you 100K over market price to do it.
Yeah, but now that those days are over, I'm telling people, when what we don't know when, and we don't know how bad, like you're saying, how what the poop's going to hit the fan. But you know very well that an experienced operator has been doing it, let's just say 5, 10, 15 or longer years. If the same problem happens to two properties, the person with the greater experience and Rolodex, they're going to be able to weather the storm a lot better than the newbie, right?
Right. Well, not only are they going to be able to weather the storm, I think we also have to look at it from an emotional aspect too. This is the side that LPs never see, is the emotional aspect too. How is your operator's emotions going to play into this? What's going to happen when things get tough and things are tight and they're not able to go on vacation 6 times next year and do this and do that and expand the way they want to expand? How's that going to affect their psyche? How's that going to affect their mental status and be able to be fully present and functional to operate and control and manage your investment properly?
Yeah, you have a great point. I think the other one is, the dirty little word in real estate syndications is capital call.
Yep.
And I've been on the receiving end of one, and it wasn't pleasant. I think many, many, many investors are in for a shock when, let's just say 6 months, 2 years from now, when they get their first, capital call. And, the idea that you just invest in real estate, it always goes up. Don't worry, it cash flows. Everyone needs a place to live. And you get the, hey, this was a high value add, highly leveraged deal. You read the BPM, right? Um, rents are down or occupancy's physical, I mean, economic occupancy is down. We need
Right.
money. I think a lot of people are going to be surprised. I'm not saying every syndicator is obviously going to be doing capital calls, but when it starts coming, I think it's going to put a real chill and wave into the industry, correct?
Yeah, I think we're going to see a lot of that as these bridge loans come to fruition here. What, February, March, I think is when a lot of them start to kind of pop off. And then, for the next 12-month cycle following that period is when a lot of those come to fruition. Now, capital calls, they're interesting how those operate. Do you have to abide by the capital call? No, not one bit. However, if they're doing a capital call, there's a reason for the capital call. And if that capital call obligation isn't met by some source, does your deal go under? If your deal goes under, then you lose all of your capital potentially, or you only recoup half of it. Yada yada yada. However that dice is up. So it's an interesting spot whenever a capital call happens. So, and this is the one thing that I don't like about real estate, among other things, but so on our hedge fund side, the way we trade equities, we are able to minimize all various types of risk exposure by the just the internal tools that we have to do that. I don't see, and I could be missing something. I don't see whenever economic shifts happen, how you're able to really mitigate your risk exposure in the real estate market to the extent, at least, that we can say on the equity side. You're pretty liable to things that are out of your control. You have no control over interest rates. You have no control over inflation. You're at the mercy of whether or not people pay risk. Every single one of those things is a liability that you can't control. You can't force someone to do anything. If if I have if things go to crap, and I'm someone who's making $2,000 a month, but it cost me $2,000 a month just to buy food for myself and my families and put gas in the car to go to work back and forth. I can live a lot longer fighting you to stay in my home and not pay you rent than I can without food and water.
Yep.
And I'm going to choose every single time the food, water, and gas to go to work for myself and my family than to pay you rent.
I mean, it just like you were mentioning, without getting into politics. We try to mitigate risk by which jurisdictions we take. And we play that spectrum game of risk and reward. The further down you go down the asset class level, in theory, this is kind of a side topic, but in theory, you're taking on higher returns if you're going into C class, and A class is supposed to be lower returns, and you're offsetting it on, people with higher credit scores, kind of care about their credit. So if it's an A class, property and neighborhood that, in theory, they're gonna be more worried about just paying the rent, and they don't want to get, an eviction on their record or have their credit score dinged.
Right.
I just, in my practice, what's hard is for most people is when we're buying single family homes, or even when we're buying apartment buildings, a $50,000 chunk all of a sudden for an apartment building syndication, or, could be hundreds of thousands or many tens of thousands on a single family home. How do you get the diversification to say, I want to be in, B's and A's in multiple states? For most people, they're buying, maybe at most a couple investments, right? That's the tough thing about real estate. For myself, now that we've hit a certain scale, we're involved in multiple states, multiple asset classes and properties. I'm not a maximalist. I don't only own real estate, obviously.
Right.
But to me, that's the thing. And for me, like, one of the big things for me personally, which I often tell investors, is this isn't a competition. I don't need to do better than Jim at the cocktail party. It's one of the biggest, I don't say fallacies, but like emotional weaknesses people have is Jim keeps bragging to me how much money he's making on his Airbnb. But that's great for Jim, but I don't want to manage an Airbnb perhaps. Maybe I don't want the risk associated with an Airbnb. My little boring duplex, maybe in the Midwest, that ekes along and makes just a nice return, and we don't have a huge loan to value on it, and the tenants just kind of pay on time, and it's not a growth market. That's fine if that fits your psychological profile.
Right.
And like in your world, when people talk about trading, they say the system is the trader is the system. And if you don't match the system to, it's not going to work.
Yeah,
Every book,
absolutely.
yeah, every book on trading that I've ever read, I mean, they're just pounding home, the key principles of risk mitigation, size position, but the biggest one is the psychology of it doesn't matter what system you're using. If you're not psychologically inclined to that system, it's gonna fail.
Yep. You could be given the best trading system in the world that always produces 100% return, but if it's not for you, it's not for you, and you're gonna
It's gonna
fail at it.
fail, right?
Yep, every time.
I see the exact same parallel in real estate. Just because your neighbor is doing great in storage, that doesn't mean it's right for you, or industrial, or fixing and flipping is your cousin's making a killing off of it. It doesn't make me match your psychology or your skill set, correct?
Absolutely, 100%.
All right.
Well, and just to kind of connect those two of the trades, there's trading systems that work fantastically in bull markets and horribly in bear markets. And I think that's worth a note for the real estate side. There's certain things that are going to work great in bull markets, not so much in bear markets. I worry for the people who are out there fixing and flipping right now. How's this going to pan out for you? You can buy an asset today, do a 3-month renovation on it, and your asset price has dropped during that period. So not only have you bought this thing, I mean, for let's say you bought it for 100,000 and you put $25,000 in real estate, or not real estate, capex to fix it up, and the plan was to sell it for 150. 3 months from now, interest rates have gone up another percent and a half. Everyone's slowing down. You can't sell this thing for 150 anymore. You're gonna have to sell it for break even, maybe a loss. Or you just have to hold on to it. Now you're eating payments. How long can you hold on and eat those payments? Not very long, typically as a flipper.
Yeah. I think across the real estate industry, now is not the time for a skinny deal.
No,
I mean,
not
like
at
you're
all.
saying, a skinny deal can be masked or forgiven in a bull market, much like I think in a lot of different traits of the investment world, a bull market can cure a lot of evils, correct?
Easily. Like I was saying earlier, in 2020, 2021, I could throw money at anything and I'd make money in a week or two. No problem. I didn't have to do analysis on the company. I just knew everything was going to go up. It wasn't hard.
Yeah. Okay.
So even having, I guess, ignorance of things, half the companies I was trading, I didn't even know who the hell they were. I didn't. I truly didn't. I didn't know anything about the company. I didn't know anything they produced. I threw money at it and still made money.
Well, during a bull market, right? All
Right.
seasons
And,
are
and that's how
forgiven.
that goes.
Yeah. I
Sure, I
appreciate.
lost plenty of times, but the
That's
amount I
awesome.
made compared to how much I lost is very negligible.
Exactly.
I'd make money on 10 and using risk management strategies, it's cut my losses early and let my winners run. So letting my winners run easily outperformed the one loss I had.
Yeah. What I wanted to ask you about was, is there any other topics for discussion for real estate investors to kind of, pull back from the tree and see the whole forest in terms of really understanding the profiles of risk returns and the factors that they should be considering, aside from, just only focusing on an interest rate, inflation. Oh my God, we might have a crash.
Yeah, I mean, it's hard right now to kind of just because too many things are up in the air. Don't get sucked in by flashy presentations. At the end of the day, any of us who are in the operator and fund space, syndication space, is a salesperson. So just because they come at you and say, "Hey, you have 45 days left to kind of get on this deal to get 100% bonus depreciation this year before it goes away," doesn't mean that you should be investing in it. So, is you have to look at that, is the 10, $20,000 you're saving in taxes worth the potential 50 that you could lose? So I think we covered a lot of the things to kind of look at least that your average person can look at. So I don't, without getting too technical and too in depth of, macro analysis or even micro analysis. I think we did a pretty good job at covering it. Unless, we want to kind of dive into, one year inflation swaps minus year over year CPIs and
Yeah, I think that would be
NAV
it.
unemployment.
That'll be a topic for part two. That'll be a
Yeah.
topic for part two. Dylan, the most important portion of the segment, of course, and when I'm always afraid of missing, so it's always on top of my mind, is how do people get a hold of you if they want to network, connect with you, possibly do business with you? And I know that you provide a lot of great services that you've been kind of coy about shamelessly plugging, but I know you're able to help investors with a wide range of tax issues and related issues. How did they get a hold of you?
Yeah. So the best way to kind of reach out, I would reach out through LinkedIn. Um, if I don't know if you want to put my link in the comment section of this
Oh, we'll
video or
do
the
that.
description. Okay, because I'm sure there's a million and one Dylan Clarks out there. It's gonna be impossible to find me. Email is good as well. Just let me know who you are and why you're contacting me. Otherwise, I'll probably skim over it. I get a bunch of emails every single day. Um, and then I'll have you put my phone number down there or at least my business line down there as well for people to kind of reach out. Shoot me a text before anything. If I get 1,000 spam calls a day, so I probably won't pick up. If you do call, just leave a voicemail and I'll get back.
Wonderful. Really appreciate Dylan. It's been a pleasure having you on the show and giving LPs just a little more to think about instead of focusing on just one or two issues.
Yeah, absolutely. Thanks for having me.